Okay, so here's an overview on VA loans. So VA loans are for active military or veterans or surviving spouse. There is no down payment for this loan, and there's also no more monthly mortgage insurance on this loan as well. And there's no loan limit, so you can buy a house up to $2 million using your VA benefits. And it's also the most flexible as far as credit score, as far as your buying power and the guidelines overall. So it's a really great loan that if you're a veteran, active military, you must use this benefit. Okay, so as far as the down payment, like I mentioned before, there is zero down payment. Now that doesn't mean that you're gonna go into this house with zero out-of-pocket cash to close and expenses, because there are closing costs, and we'll get into a little bit more in depth with that. But with this loan, you can have the seller pay for your closing cost up to 4%. So if you're buying a house for $400,000, the seller can give you $16,000 to cover your closing cost, which would be very helpful. Okay, so here's just a basic overview of what closing costs are. So VA does have a funding fee, and we'll go over that a little bit more in depth, because there are instances where you can be exempt from this funding fee. But standard basic closing costs are title fees, which is the cost of transferring ownership from the seller to the buyer. You have your appraisal fee, which is making sure that you're buying the house for what it's worth. Also setting up your escrow account. So your escrow account is paying a portion of your property taxes and your homeowner's insurance up front. So you always have that in your account. Okay, so let's talk about funding fees. So funding fee is essentially mortgage insurance. Think of it, you're paying it up front and it's wrapped into the loan, so you're financing it. And a lot of times there are instances where you can be exempt from this. And here's a breakdown of the cost of the funding fee. So as you can see, if you end up putting more down payment than just the required 0%, then that decreases the funding fee. Okay, so let's talk about your entitlement amount and how to figure out if you're eligible to use your VA loan to the full benefit. So we look at your certificate of eligibility. Now, if you're one of my clients, I actually pull this for you on your behalf. I go directly to the VA. And if you have your full entitlement, then you can use your VA loan with 0% down. This is also where we will find out if you're exempt or not from the funding fee. Now, most likely, if you are a disabled veteran, you're more than likely exempt from the funding fee. Now, it is possible to have two VA loans at once. Now, there's certain requirements and there's very specific guidelines, but yes, it is possible to use your VA 2 times. Okay, so as far as credit score, technically there is no minimum credit score for a VA loan. However, you will see if you have a 580 score, you're gonna get killed, or in that range, you're gonna get killed on the rate and the fees on this. Now, the next benchmark, you're gonna see a huge difference. If you can get your score up to a 620 or above, you're gonna get a lot better interest rate, you're gonna get a lot better fees and a lot better loan terms. Now, how we determine your credit score is we look at the middle score out of all 3. So if you have a 651, 652, 653 score, we're gonna use the middle score right here. Now, I get this question a lot. If there's 2 people on the loan, do we go with the highest? Here's how we do this. So in this same example, let's say here's borrower 1's 3 credit scores. Here's borrower 2's credit score. Borrower 2 has a 701, and borrower 1, that's their middle score. Borrower 2 has a 652 credit score. We look at the middle scores from both of the borrowers and we use the lowest one. So even though the other borrower has a lot better credit score, we would use the lowest middle. Okay, so let's talk about having joint borrowers and having several people on the loan and still using your VA benefits. Now, the VA is very specific on this, and I probably get this question asked all day long, like, hey, I want to use my VA benefits, but I want to have my mom on the loan. So here's the breakdown. If you want to not have a down payment, the only other person that can be on the loan is your spouse. Now, if you have a non-vet on the loan that's not your spouse, but is still going to be living in the property, then that changes. It goes from 0% down, then you'll need 12.5% down. Now, VA, this is very specific to this loan. VA doesn't allow any non-occupant co-borrowers. So a lot of times on different different loan types, we will add a person that it's not going to be living there, but they're helping bring up the pre-approval amount by using their income to qualify for the loan. VA, you can't do that at all. Everyone that's on the loan must be living in the property. So as far as your income and employment, you really need to have a job history for the last 2 years. Now, it doesn't have to be in the same job, it doesn't even have to be in the same line of work, but you just need to show that you've been working somewhere for 2 years. And what they do, if you are a W-2 employee, they will ask for your last 30 days of your pay stubs or your LES and your W-2s for the last 2 years. Now, if you're self-employed, it's a little bit different. They look at your last 2 years of filed tax returns. And what they do is they look at your overall income, and then they minus your expenses and all your write-offs, and that will equal your taxable income. So it's important to note, if you're self-employed and you're preparing to buy a house, start working with your CPA now. Tell them up front, I want to buy a house, so let's not write off as much expenses so we can keep my taxable income a lot better. Okay, so now let's talk about your military income. So what income we can use is we can use your BAS, we can use your housing, we can use your uniform allowance, and we can even use, like, if you get any family separation income. And if you're a veteran, we can use your disability and also your pension as well. Now, it's important to note what we cannot use is the GI Bill. A lot of people get this confused. And the reason is the underwriters look at it as temporary income. So they look at it as this will stop at some point. So they do not consider that as income. Okay, so as far as your debt to income ratio, you're gonna hear this term a lot with lenders, and all what it is just the percentage of the amount of income that goes to your monthly debt. And VA is typically the most flexible in regards to DTI, debt to income. So that means that 60% of your monthly income can go towards your debt. It's important to note, you know your situation best, so this is how the banks calculate it. Just because they're giving you a loan doesn't mean that you have to take it. You must be comfortable and it must work with you. Now, like I said, it's the most flexible loan, VA 60%, because as you can see on an FHA, they can go to 56%, on a conventional, they can go to 50. So you're likely gonna get pre-approved for a lot more on a VA loan than versus an FHA or conventional. And here's what they consider as monthly debt. This would be what's typically found on your credit report. So your car payment, student loan, credit card bills, personal loan. They also look at the future mortgage payment of the house that you're buying, and they consider that into your monthly debt, and also child support and alimony. Now, I get this question a lot. Things that we do not consider monthly debt in your debt to income is rent, utilities, and cell phone. Okay, and here's how to calculate your debt to income ratio, and you can do this with me. So number one, what you want to do is add up all of your monthly debt, and that's going to include future mortgage payment as well. Then you're going to divide your monthly debt by your monthly income. Now, it's important to note that we look at your gross monthly income, not your net. Then to get the percentage, you multiply that by 100. So here's a quick example. So let's say your total monthly debt, including future mortgage payment, is $4,920. Then you divide it by your household income, the gross, which in this example, we're going to use $9,000. That equals to 0.46, times that by 100, and that would give you a DTI of 55%. Okay, so as far as property types, what's cool about this loan is you can buy a single family home, you can buy duplex, triplex, quadplex, as long as it's your primary residence. So as long as you, let's say you're buying a duplex, as long as you live in one unit, you can rent out the other. And they actually use the rental income for the other unit to help qualify you. So you would be able to get pre-approved for a lot more on a duplex, triplex, or quadplex versus a single family. Now, you can also buy a condo with this type of loan too, but it's important to note with condos, they're a little bit more strict, and the condo must get approved by VA. Okay, so as far as appraisal requirements go, the VA is very specific on the condition of the property that it must be in for the veteran to buy, and it needs to pass different like health and safety inspections, and it almost needs to be move-in ready. So think about that when you're looking at properties. Now, it is the most strict appraisal out of FHA and conventional, and also what you need to have done is a separate termite inspection. That's very specific to a VA loan. And if the appraiser finds anything that needs to be fixed, the seller will have to have it fixed by a licensed contractor prior to you closing on the homes. And here are just general issues that if the appraisal sees it, it must be fixed. So any leaking roof, any water damage, any rotting wood, any exposed wiring, any termite issues, any broken glass, anything like that, they will condition that it must be fixed again by the seller before you take ownership of the property. Okay, so here's a really good strategy on how to use your VA benefits to build up a real estate portfolio. So use your VA loan to buy your first house. Even better if you can find a duplex. Like we said earlier, live in one unit and rent out the other. And you can have the sellers pay for your closing costs. You can have them pay to buy down the interest rate to get your payment a lot more affordable. And all you have to do is just live in the property for 1 year, and then you'll be able to rent it out and then go buy another house and just repeat the process. Okay, so here's how to apply. So it's important to note that the VA does not directly lend to the public. They are only insuring the loan. So you would need to apply with either a mortgage broker, credit union, direct lender, or bank. Now, you're gonna see a lot, this is a marketing technique. You're gonna see a lot of places that different companies put VA in their name, and it's kind of misleading because you think that, oh, they are the VA themselves, I can only use them. And no, it's just a marketing technique to attract veterans. Now, what's the difference between all three? So as far as a credit union and a lender and bank, when you go to them, they pull your credit one time and they give you one set of fees, and you're stuck with their fees and their interest rate. And also you're stuck with their underwriting. So if they are not able to do the loan, if they deny you, you have to start all over at a different place. Now, the benefit of using a mortgage broker is with one credit pool and one application, they can shop your rate among 100 different banks and get you the best deal possible that's based on your scenario. And if something happens and the loan gets denied, then you yourself do not have to start all over again. They just take your same application and knock on the door to another bank. So they essentially do the work for you. This is what I am. So if you need my help, if you have any questions, click on the link in the description. It goes directly to my calendar. You'll talk directly to me. And I hope you found this helpful, and I'll see you on the next one.